Hi guys, welcome back to the Joyful Investors channel. The stock market retested the June lows since the August inflation data was released, and a hawkish Fed which says that it will take forceful steps to bring inflation down to 2%. Well, that sounds pretty scary, right? So are we going to see a bigger crash coming? Whoa, before we panic, let's take a look and slowly break this down. So firstly, let's ask ourselves, what is causing the sticky inflation? If we take a look at the CPI data, energy would definitely be one of the categories that is causing the high inflation. And on top of that, food, transportation, and shelter, which is also housing, also contributed to the high inflation that we see currently. So the next question to ask is that, how have the prices of these categories changed over the past few months? If prices are coming down, then that would be a good sign for inflation and the stock market as a whole. So let's begin with energy prices first. Although the August CPI data for energy index has declined by 5%, the overall energy index still rose by 23.8% over the last 12 months. That's still very high. But the problem here is that CPI data is lagging data. So any change in prices of the inputs will only get reflected in the CPI data after some time. So in my recent Zoom sharing session, I shared that if you want to get a better understanding of how inflation rate might change in time to come, then instead of focusing on the CPI data, you can consider looking at prices of the inputs which will directly impact the inflation rate. For example, the crude oil futures price chart or the natural gas futures price chart. What I want to observe is that oil prices and natural gas prices continue to come down for inflation to fall. And at that moment, we are seeing that price decline, which is something good for the current inflationary environment. But of course, the oil prices and natural gas prices are currently still more on the elevated side. So what we hope to see is that the oil prices continue to come down even more for inflation to fall further. But at least the energy situation is improving and it is not all gloomy. Before we go on, let me quickly share a quick message from the sponsor of this video, uSMART. uSMART is currently running a promotion this month and next month where you can receive monthly cash and stock vouchers worth up to $400 when you open a uSMART account, deposit and trade. From now till 31st December 2022, you also get to enjoy unlimited zero commission fee for US, Hong Kong and Singapore stocks, and there is no minimum charge for Singapore stocks. Terms and conditions apply. uSMART is also one of the few brokerages which offer fractional shares trading and featured strategies curated by uSMART market strategists and analysts for investors. If you are keen, you can look for my referral link in the description box below. And let's proceed on with the second factor that's causing the sticky inflation, and that is global supply chain pressure. The global supply chain issues surfaced since the outbreak of COVID, which were then escalated by the Russia-Ukraine conflict and the renewed lockdowns in China. But the good news is that we are seeing progress in the global supply chain pressure. If we take a look at the Global Supply Chain Pressure Index, which integrates transportation cost data and manufacturing indicators to provide a gauge of the global supply chain conditions, we can observe that over the past 4 months, there has been easing of the global supply chain pressure. Freight costs have also come down over the past few months. Take a look at trucking spot rates. They've come down since the peak in January 2022. And container freight rates have also been declining from the peak over the past few months. All this will ultimately help to cool down the high inflation. Moving on, the third factor which is driving the sticky inflation is the housing prices. Rising housing prices also translated to rising rental rates. But right now, with the rate hikes, the 30-year mortgage rate has increased to 6%, which can help to cool down the housing market. If we take a look at some statistics, the existing home sales and new home sales in the United States have been declining since January this year. So we are headed in the right direction. But for us to see the impact on the housing prices, it has to take more time before the housing prices can cool down further. As I've shared in my recent Zoom session, what we can observe now is that there are indeed improvements to the energy prices, the supply chain pressure, the freight costs, and the housing market over the last few months. However, it has to take some more time before we reach the optimum level to pull down the inflation further. Just like a person who's trying to get healthier by working out more, it doesn't happen all of a sudden. But over time, you should get better readings, say from the cholesterol levels or your BMI and so on. And more importantly, the stock market is not the economy. The stock market usually moves ahead of the economy. That means before the economy recovers fully, the stock market usually recovers first. Let me show this to you. If we compare the historical S&P 500 performance versus the historical US inflation rate, this is what we can observe. During the Great Inflation period from 1965 to 1982, whenever the inflation rate peaks, the stock market is usually near the bottom. So if the inflation rate really peaks at 9.1% in June this year, could we be near the stock market bottom? No one can give you a definite answer to that. But the whole point of showing this chart to you is to tell you that we don't have to wait until the CPI data comes down to a low digit before we see the stock market recovering. If you are an investor with a longer term investment horizon, then the current market volatility may be a good opportunity to buy more shares of the good businesses or to invest into the S&P 500 for those who prefer the broad-based index. This is also part of the Moneyball investing methodology that we talk about at TGAI, to be buying great businesses at depressed prices due to them being temporarily out of favor. In the short term, some of these businesses' earnings may be slightly impacted in 1 or 2 quarters, but they are the ones with the strong financials to eventually tide through the tumultuous economic environment, whether it's inflation or is it recession. So if you have enjoyed this video, do smash on the like and subscribe button. And if you want to stay updated with our investing insights, do subscribe to our Telegram channel and join us on our regular Zoom sharing sessions. See you in the next video.